So welcome everyone to today's session of Capital HQ Masterclass on asset-based financing. I'm Hugo, I'll be your moderator for today's session. We're here to explore the intricacies of asset-based financing, a key strategy for businesses looking to leverage their assets for growth and stability. Today, we've brought together industry leaders to share their wisdom and experiences with this financial instrument. So first, I want to begin by introducing a leader in the field of technology and finance, Jan Zulko. Jan is the CEO and founder of Everphone, an innovative company that's pioneering the device-as-a-service sector. And with a proven track record of driving growth and operational excellence, Jan's leadership has seen Everphone scale new heights in the B2B market.
So, hi everyone, I'm Jan, I'm the founder of Everphone. I founded Everphone 8 years ago on the premise that it is very complex to manage mobile phones in corporate settings. So if we think about what does Everphone do, simplified said, we rent out mobile phones. And that now sounds like something very simple. You buy a phone and you rent it out. But the true complexity on the side of companies is that it's not just going into a shop, buying a mobile phone, giving it to the employee, and the employee can use it, but it's actually that, first of all, the mobile phone has to, and mobile device management has to be put on the phone, the right apps have to be installed, it has to be sent to the address of the employee if they're in the home office, the logistics have to do at the end. The device has to be wiped again from the data that's still on that, has to be refurbished and reused. So the entire life cycle, as it's called, is a very complex process for companies. And all of this, of course, has to be managed. The assets have to be managed. The company needs to know which employee has which device and so on. The second thing that is always a problem for companies owning the device is, of course, the financing part. As often when employees leave the company, they give back the company-owned phone, of course, as they should. But then the company is stuck with a relatively new mobile phone. So what does the company do? They can't just sell it on eBay. So in the end, what they do is it usually stays in the drawers of the company. So Everphone thought of a solution that solves all these problems in one step. And that's, in the end, Everphone buys the asset. Everphone goes deep into the processes of the company to understand which software has to be installed, which mobile device management is needed, which cybersecurity needs to be on the device. But we all manage this. We directly interact with the employee. And this is crucial for the session, of course, we own the phone. So at every given time, we own the phone and we basically give a usage license to the users to use this device. And there is one great aspect: full flexibility. If an employee leaves the company after 6 months, they give back the device to Everphone. Everphone doesn't charge the company anymore. That's simplified said what we do. So in the end, we do the entire management of the devices and the financing part. Of course, as you can imagine, by now we have roughly 400,000 devices under management. Those are a lot of phones. The average phone is about $400 to $500. So we need a big debt facility to finance all these assets. And especially with part of the revenues at the end of the life cycle, the residual value of the phone in the end, this makes it a relatively complex financing structure. And this is what Dietmar and Veronica is going to tell you about in the session today.
Great. Thank you very much, Jan. And for anyone who's interested, any founders or even investors interested in working with you guys, how would they go about doing that?
Yeah, so mostly we are focused on large enterprises. So it starts at 1,000 devices. So we are more for the corporate customers, but of course, grown-ups, let's call it like this, or interested larger companies. They can directly contact me. I love hearing about the user stories and the demands in the market. So just contact me on LinkedIn. It's usually the easiest way. Just Google my name. Thankfully, I have a very unique name. So just Google me, send me a request, and I will shortly answer. And if you're interested in the product, happily do that. If I can support other founders, I'm a big fan of entrepreneurship. Also always happy to at least give my 2 cents of advice.
Thank you very much, Jan. It has been a pleasure. So We just had the privilege of hearing Jan, Everphone CEO and founder. I now have the privilege of having Dr. Dietmar Helms with us, a partner at Hogan Lovells and a leader in the legal domain of asset-based financing. Dr. Helms brings a wealth of experience in structured finance transactions, having advised on several benchmark deals. His legal acumen has earned him recognition across leading lawyer rankings, making him the ideal expert to guide us through the legal framework of asset-based financing. So now we're just going to hear a short keynote from him. Thank you, Dietmar.
Thank you so much, Hugo. We have been introduced over the last years to a number of companies such as Everphone, new business models with a significant need for funding. As Jan has already explained, those use cases are typically in the sharing economy as a typical use case, where they replace ownership and provide services both in the B2B field as well as in the B2C field. We also see that now in the consumer finance space. We have advised a number of solar companies and heat pump companies for the energy transition that want to offer consumer finance solutions to their customers. So finding the right balance of funding or the right funding mix is a particular challenge for these asset-heavy startup companies. Apparently, the access to traditional bank lending is particularly difficult if you are a young company. Everphone already is a now established player in the market and can obviously seek bank funding. But when I met Everphone a number of years ago, they were still young in the market with short track record and would usually not get a traditional unsecured or secured bank lending. Also, the other possible route would be a sale and leaseback structure, which might not particularly fit to the very flexible business model that Everphone wants to offer to his clients. On the other side, the pure equity financing would also be very inefficient and too expensive. So apparently, these companies need to find the right mix of equity finance and debt financing. So startup companies were often led to seek funding through venture debt, which might work or may not work in an ideal form because it comes with a lot of restriction on the further growth and might not be the best solution for a high scalable business case such as Everphone. So we have invented the kind of asset-based lending structures that we are talking about in more detail today. So what this structure is mainly about, first of all, we have to distinguish financing models which look on the pure receivables financing versus an asset-based lending type of structure. So in a receivables financing, for instance, if you have an installment purchase contract, which would fully amortize the asset at the end of the lifetime of the contract, then we would set up a kind of a factoring structure where we would purely sell and fund the receivables. Where in another case, like in Everphone's case, we might have a short rental period, which would not lead to a full amortization of the asset, where we would also look in particular on the asset value itself. So the difference to a traditional bank lending in an asset-based lending structure would be that we try to set up a structure which allows investors full control over the assets and over a potential enforcement scenario where they have to segregate the assets in an insolvency of the respective company. So the main advantage is that the creditors are not just secured creditors in a potential insolvency proceedings, but they can actually segregate the assets that they have financed. They can control the enforcement process itself. They can avoid costs and additional time for an insolvency administrator to take decisions on the enforcement and give them a much better position either to control the enforcement itself or to negotiate with the insolvency administrator how to best enforce the collateral. Thank you, Hugo.
Thank you very much, Dietmar, for that launch into asset-based financing. Today, we're joined with Dietmar and myself by Dr. Veronica. She's the Chief Financial Officer and Managing Director at Everphone. Veronica's journey in finance has taken her from the structured world of banking to the dynamic and fast-paced startup ecosystem. For this panel, we will navigate the landscape of asset-based financing, exploring its roots, and going into the mechanics and advantages of leveraging company assets to secure funding, a concept that recently, as Dietmar has pointed out, has been pivotal for certain companies in terms of growth. So our discussion will dissect the nuances from the initial evaluation of assets to the intricate legal considerations. So let's kick off maybe with Dietmar first. Going back to its very core basics, could you define asset-based financing and explain its core components?
Sure, Hugo, thank you. So I think the main idea of this asset-based financing or asset-based lending, as we call it in the case of, for instance, Everphone, consists of really segregating the assets from the operating company. In these cases, we set up an insolvency remote entity, which becomes the owner of the relevant assets, meaning here in this case, iPhones or iPads that are rented out by Everphone to its customers. And the only link between this insolvency remote SPV and Everphone would be a service contract by which Everphone would then still provide certain services, the marketing of these products to its customers, the collection of payments from the relevant customers, and the maintenance of the relevant devices. We would then, in addition, have a backup servicer typically in place, which is a standby solution in case the operating company becomes insolvent, so that the creditor has someone to turn to take over the enforcement and the wind down of the collateral.
Okay, great. And Veronica, from a CFO's perspective, why is asset-based financing, at least in your opinion, becoming a suitable choice for startups and scale-ups?
So this is especially relevant for asset-heavy business models such as ours. So procuring an asset, usually a mobile asset, that is leased out or rented out to consumers or B2B, and that is generating steady cash flows. In ancient times, this was typically automotive leasing contracts or rental contracts. Nowadays, we can finance pretty much every asset from smartphones to other mobile devices to electro scooters, but also handbags. And to scale such a business model, the company would need a steady influx of assets they could rent out. And obviously, this cannot be happening with equity in a scaling business model, just because equity is the most expensive form of capital, priced at roughly 15 to 20% margin, whereas asset-based financing, if done in the right structure, can be obtained at margins of under 5%, and therefore having such refinancing in place can help significantly scale and also make a asset-heavy business model profitable.
Right. And just a question on that. So what's, maybe for either one of you, what's changed in the financial industry to allow for this larger scope of financing, of asset-based financing, going from maybe just some cars to now pretty much everything?
Well, I guess many startups who have tried to reach such financing and who have had the right support, amongst others, Dietmar, who has helped banks to understand the concrete risk of the asset and the startup and found a solution how to contain the risk in a way that it's amenable to a bank rating.
Right. And Dietmar, coming to you now, with your experience in securitization, what due diligence processes would you say are essential for companies to undertake when securing asset-based financing?
I think we look at a number of questions when we get introduced to a new startup or scale-up company that seeks debt financing. So we really try to educate this company to take a look at their own business as if they were lending debt funding to themselves. So we are really looking at everything starting from the credit process, the client customer intake process, fraud prevention process, 4 I's principle, all these typical questions that a debt investor would later ask in the process. We are looking on the underlying contracts that they have with their customers, whether they are all solid and are suitable for refinancing. We are looking at all the compliance issues, whether or not they have the required licenses in place. And obviously, the whole organization of the company itself is up and running and working. Yeah. So these are typical companies that haven't been around just for a few days, but they have already at least a certain short track record and have proven that their business model is solid.
Right. And sticking with you with regards to, apart from the fact that it's asset heavy, what criteria makes a business a good candidate for asset-based financing? Does it matter where they are in the stage, whether it's Series A, Series B, or further down the line? What kind of criteria does make it?
I think it should be a solid business model that people believe into. They should have reliable founders and people in the management of the company with a certain track record. Often we have serial founders such as Jan, who has in the past already set up other businesses before that and has proven that he has the right skill set to come up with the right business model and also brings together the right management team that can run that business. And obviously, although we provide significant amount of the funding for debt funding, the equity component obviously also plays a role, especially in times where it's no longer that easy to raise another capital round. So debt investors are also looking at rundown rates, etc., because they don't want to fund a business that is at the edge of becoming insolvent in a very short period of time unless they can raise another equity round. So I think debt investors have become a little bit more cautious about this approach.
Yeah, we'll get into asset-based financing versus equity financing. I think a lot of founders probably watching this are interested in that. But coming to you, Veronica, with Everphone's innovative business model, could you discuss how asset-based financing fits within your broader financial ecosystem, especially compared to perhaps traditional lending models?
So we have something in place that I call the golden balance sheet rule. This means that all of our growth, which is invests in people, in tech, in marketing, is financed by equity. This is something that is of vital importance to investors, and that's why they finance it. On the other hand, all of our assets rented out to clients are debt financed. We're doing this exclusively by asset-based financing, just because this has been proven to be the cheapest and the most accessible form to us. But obviously, it would be also possible to run such a model and include venture debt capital or include traditional corporate lending on, let's say, our inventory or the like. We have it covered in our structures, and that's why it's not necessary. I'd also like to underline the high availability of debt capital even in terms of economic crisis. So we had the COVID crisis, we have the funding crisis for startups that has basically been happening in 2023 since the collapse of Silicon Valley Bank. And during all those times where equity has been very scarce and very expensive and difficult to supply, debt capital was pretty much freely available on the market if you had the right business model and if you were able to prove that it's sustainable. I've raised one facility during COVID at my former employer. We raised our current facility at Everphone during this time of 2023 crisis, and there were never a lack of, let's say, available banks in the market that would have been able to do this deal, whereas equity investors are just difficult to find.
Right. And can you maybe share an example from Everphone or your past experiences where asset-based financing was effectively utilized? And perhaps maybe the first time you guys used it at Everphone?
Yes, indeed. This is a funny story. So Everphone was at the start a B2C club. It's what's called a smartphone club because Jan dropped his device and the screen broke and he needed a new one and thought, well, everyone's having that pain at some point in their lives. Then they pivoted to B2B because one of their private customers was a salesperson and they wanted to equip all of their colleagues in sales with a phone. And that's when the business model pivoted. They acquired some minor clients and were able to buy all those devices with equity. But then they out of a sudden acquired a Big Four client from a large advisory firm, and they wanted to roll out 10K devices within 3 months. And that was the point in time when Everphone realized that they wouldn't get the equity to buy all those phones. And when they started setting up and investing into a debt facility, this was set up with a smaller fund because Everphone indeed didn't have a track record. It was a very easy structure via a promissory note. And over time and with more track record, Everphone has set up 3 more facilities, each with larger banks, each more complex, but also each cheaper, ending with that private securitization we've set up by the end of 2023.
Yeah, it's cheaper, more complex. That's where you need the both of you to come in. 'Cause,
Obviously, it goes hand in hand.
yeah, absolutely. To Dietmar first, maybe, how does the scalability of a business impact its abilities to secure asset-based financing?
Yeah, I think it's a cornerstone. Obviously, this complex structure isn't suitable for a company that does not seek to really grow in size. While we start doing these structures with a minimum debt funding of about 5 million euro, I think the expectations of lenders would be that the business would ramp up in a relatively short period of time to at least 10, 15, 20 million to make it cost efficient. I think a business that would stay at a financing volume of 5 million should seek for a less complex type of financing.
Right. And for you, Veronica, how have you found when Everphone started reaching scalability? Did you find it easier to secure asset-based financing or not really?
Yes, indeed, because I believe the credibility that the early banks lent by investing into Everphone also made us attractive to larger partners. By then, we had a proven track record of fulfilling our debt, of securing additional funding, of also delivering in terms of remarketing our assets in claims management and all the like, and being able to show a 2 to 3 year full history in a very data-based setup is very convincing to banks. So it's probably not the fault of those very early stage startups if they can't reach asset-based financing. It's just a lack of data and a lack of history that's oftentimes detrimental to getting such type of financing.
Right. And coming to you, Dietmar, before we go into asset-based versus equity financing, I think it's important in terms of the evolving definitions in the financial sector. How would you differentiate asset-based financing from other forms of secured lending, particularly if we focus on a startup/scale-up audience?
Yeah, I think it's a more elaborate way of financing. It is also using concepts of secured lending because this special purpose vehicle, which becomes the owner of the assets, would typically also grant security over the assets as an additional belts and braces protection for the investors. But the main idea is really to segregate the assets from the operating company. I'd like to point out another point to what Veronica has mentioned before. I think key for this financing to work is really to also have the right asset class. Traditionally, banks would probably not have financed against a portfolio of handhelds, mobile phones, because they couldn't evaluate the asset at a certain point in time. I think the availability of data was one of the key factors that has helped to really make this product more reliable for investors, so that companies such as Everphone could really provide sufficient data to their investors and to prove at any point in time they can have a very accurate evaluation of the asset portfolio. This is the one point that is important. The second point is that you also have a liquid secondary market. Today, as you can see on eBay and other platforms, these assets that are rented out by Everphone are traded in the thousands each and every day. So not only have you reliable data, that it's not a random number that you would get for a used iPhone, but you would also have enough comfort that you can sell several thousand iPhones in a very short period of time on these platforms. And this is also a key factor for a debt investor to really grant funding on that basis.
Okay, great. Thank you. So look, now let's move into asset-based versus equity financing. And Veronica, you touched upon it already with your golden balance sheet rule. It'd be great to maybe find out how you came to that, or was it a term you learned somewhere else? And when did you decide to apply that the first time?
Well, I believe that's a kind of inherent business logic. A bank would not be willing to finance a client's growth unless this was some debt that was specifically designed to that and would have a venture debt component. And on the other hand, investors would not be willing to invest the very scarce equity at a very high interest margin in financing something very basic that a bank would be also ready to finance. So it's kind of leveraging the two components to the best of our knowledge. And indeed, it's customary to combine equity and debt Indeed, it's customary to combine equity and debt fundraising, as it happened during our Series C in 2021 and now in our Series D, because for equity investors, a company being able to obtain bank financing is a sign of strength, and that's why they're super interested in companies achieving such. And on the other hand, for banks, an additional equity provides a certain security cushion, and if they are able to fund the junior tranche or the equity injection into a facility for the duration of that facility, and can prove they are able to do so by an equity injection, this is also some stability in the bank's view.
Right. And Dietmar, from the investor side, perhaps, if you can talk a bit about the scenarios where asset-based financing offers better investor security, perhaps, than equity financing.
Yeah, obviously, debt financing always ranks ahead of equity. So if you are equity investor, obviously you come at the very end of a potential liquidation of the company. So any debt investor, by definition, is already ranking ahead of equity. And the structures that we put in place are offering even more comfort to investors, that they can actually segregate assets from a potential insolvency, so that they would not only rely on insolvency proceedings and a potential sort of payout from the insolvency estate, but they can actually segregate assets from companies such as Everphone and liquidate them themselves and have more control over the proceeds that they can get out of these assets.
Okay, and in your experience, because we've heard from Veronica how equity financing and debt financing coexist, but in your experience with the companies you've helped in the past, how do those, in your experience, coexist in terms of, for example, a specific funding round? Are they usually followed by one another? Are they usually done together? Are they separate? How do you usually see those?
We often see them kind of combined, as Veronica described. So often we see a certain condition in the debt funding that equity is raised at a certain point in time. And on the other side, equity investors also sometimes demand comfort in respect of the availability of that funding, so that the funding actually occurs at the same point in time, as we have often seen in the past. It's not a prerequisite. Sometimes you also have like a post-closing covenant in the debt funding that the next equity raise is going to happen in a certain period of time after the debt funding closes. But sometimes it's really combined to happen at the same point in time.
Okay, thank you. And then just moving on to the applicability across different business stages. So Veronica, can you maybe go a bit deeper into how asset-based financing has supported Everphone's growth from a startup to scale up? And if you saw a big difference when you were just doing equity to now using asset-based financing?
Well, I believe that asset-based financing has enabled us to grow. We would never have been able to secure as much equity, especially during those difficult phases on the equity market, but also generally in Europe, to be able to maintain a high growth profile and roll out over 200K devices a year. So this is something that cannot be handled by equity. It might be able to be handled with an US venture capital investors usually are able to supply bigger tranches, but securing equity tranches of, let's say, 20 or 30 million makes you a larger fundraiser in Europe. And this would basically, if we use that equity to buy phones, this would probably bring us through, let's say, a quarter to half a year. And so we would never have achieved the growth that we experienced with Everphone.
Right.
Also, in times as those, profitability is getting more and more important. At one point, investors would demand to reach profitability, which we can only achieve once we have a significant number of assets under management, because there are functions such as mine that only scale when they tackle larger asset numbers. And this means getting more profitable over time. We would have to improve our interest margins, as we have done in the past, but we would also be able to scale and have economies of scale throughout all our business, because we have a larger base of assets. We can distribute those general costs too.
Right. Thank you. And coming to you, Dietmar, kind of a two-part question. How did you get into this world, your personal journey into this world of asset-based financing? And what types of assets were most commonly used maybe when you started compared to now? And where do you think that's going? Will it be applicable to absolutely everything in the future, or will it still remain somewhat closed off to certain things?
I think my introduction to asset-based lending happened about 10 years ago when I happened to sit next to a young man at a closing dinner, and he told me about some startup companies that were going to be founded in Germany, in Hamburg, Munich, Berlin, sort of the hubs in Germany for this type of financing. And we started to look at business such as Everphone and similar companies in the market that had tradable assets. And we were thinking about what could be a potential structure to get access to debt funding for these types of companies. So we actually used a structure that was used before in the car rental space, which is kind of a similar use case where you have very short rental periods for vehicles that would not lead to a full amortization of the assets, but also have this element of an asset segregation in a special purpose vehicle. So when you seek debt funding, you typically try to replicate a structure that is already bankable, that is used to banks. You don't try to invent something completely new that no one has done in the past, but sort of make this transition from a car rental structure to this kind of asset-based lending structures. That was, I think, the new element, and using it for new assets such as mobile phones, and to convince debt investors that they have sufficient data available to make an asset-based lending and asset-based test for the asset value itself. That was also new in the market. It was a very common feature for the car space because you have this residual value list provided in the Schwacker list in Germany, for instance. So you have reliable data in the market for used assets, but we only had to create that same level of comfort for debt investors for new assets such as Everphone's mobile devices. We have seen in the past other use cases. So we have recently financed coffee machines, we have financed handbags, we have financed e-scooters. So there's a large variety of assets, but the crucial questions are the same as I discussed before. So it is important that you have sufficient data available for the assets to really come up with a day-to-day valuation of the asset portfolio. And you need to have a liquid secondary market so that in case the operating company ever becomes insolvent, you can appoint a backup servicer and you know for sure that you can liquidate these assets at the value that you expect to receive.
Okay, thank you very much for that. And to Veronica, could you maybe, we've talked about all the positives here, but could you maybe discuss a specific challenge you faced while arranging asset-based financing and how you overcame it?
I guess I can iterate on Dietmar's point here. At Everphone's beginning, it was very difficult to convince the investors that our assets are indeed fungible and that we can sell them off at a value larger than zero. So what we had to do, we had to prepare the data ourselves to be able to prove to banks that this works out. We set up a data product, which is basically a crawler that crawls the internet for B2C prices. Then we have a mechanism that converts B2C prices into B2B prices because we usually sell off large bulks of phones. And this is what, in the event of Everphone's insolvency, banks would also do. And we have, of course, to be able to predict the future value of the handhelds and devices that we are buying today. And that's where we employ machine learning in detailer deep forest technology. This data product enables us to predict the residual value of a phone, any phone with any minimum duration of the contract, with any make and model. And of course, over time, we have been able to prove to banks that this mechanism works. And we are in a 95 confidency interval of meeting our expected returns 2 or 3 years later. Being able to prove this made refinancing much easier and also guarantees us that the banks not only finance the cash flows arising with B2B customers out of the asset, but also the residual values. And again, as said before, it sounds very easy to set this up, but it needs a lot of structure, a lot of work, and it also needs time to be able to present a data set of, let's say, 3 to 4 years to banks
Mm-hmm.
in order to really convince them.
I can
think
tell you
another
definitely doesn't sound easy.
I think another component that was crucial to the success of these structures was also that we now have certain service providers in the market that provide backup servicing for these products that wasn't existing before. So when a backup servicer in the past for a securitization transaction, these were debt collecting agencies. So they could only collect outstanding receivables, but they could never collect assets such as mobile phones, refurbish them, and sell them in a secondary market. So over the last number of years, we have seen such service providers to really occur on the market, see that as an own business model, and they are now implemented in these structures. And this only makes it viable and comfortable for a bank to invest into such a product.
Right. And look, I want to kind of move on to something that you're specialized in, Dietmar. We've talked about operational hurdles, a bit of financial hurdles, and structural hurdles for companies. But what legal hurdles do companies typically face when setting up asset-based financing structures?
I think it's more the complexity. It's not a straightforward secured lending where you just have a credit agreement with a bank and a security agreement over your assets. You have to set up a new entity. This can be a subsidiary of the operating company. It can also be an orphan SPV, which is held by a Stichting. So this is completely separate from the operating company. You then have to set up a servicing agreement between the operating company and the asset co, whereby the service company would then provide every service that is necessary to really market the product, because the asset company doesn't have its own employees. It's just owning the assets, but it shouldn't have any employees by itself. Then also you have to set up these backup servicing agreements, which are tailor-made contracts that are really then meeting the investors' requirements for a reliable backup servicing in case the operating company becomes insolvent. And then we also take a close look and due diligence on the underlying customer contracts. So the whole process really to set up is a little bit more cumbersome, but I think over the last years we have gained a lot of experience and we can replicate certain use cases.
So yeah, so for companies who want not an easy way, but a more tried way, they should just come to the both of you and get your insights. Could maybe staying with you, Dietmar, could you share an example where asset valuation proved challenging and how it was resolved, perhaps?
I remember one case where we have set up an asset-based lending, for instance, for an e-scooter company, and the public perception of e-scooters at that time was really a disaster. Everyone thought that these scooters have zero value after a short period of use. And so no one was really prepared to lend debt to finance the acquisition of e-scooters. So this company that we have advised set up its own platform where they started selling used scooters after the use of 1 year time to really prove that these scooters still have a significant residual value. And I think this has provided sufficient comfort for debt lenders to invest into that structure.
Right. And for you, Veronica, has there been a time at Everphone where it was asset evaluation was difficult, or had you set up everything from the crawler from the get-go?
We had set it up very early on, but obviously we didn't have results until the first cohorts of our phones came back and had been sold off. So for 3 years, we had to basically convince banks to trust in us and in our system without having real data to evaluate it. And this made refinancing at this point in time, on the one hand, very expensive. And on the other hand, not comprehensive, which means we couldn't refinance a very large proportion of the capital expenditure of the smartphones, but we had to bear a large junior tranche.
And for you, Dietmar, how do you see this landscape, and perhaps in a legal term, evolving in the next few years, perhaps technology influence or something like that?
I think it has become now tested and debt funding structure, which is now more familiar to more banks. So in the beginning, there was only a very limited number of investors that would actually explore that new way for funding startup companies and scale-up companies. I think now we see bigger tickets in the markets. We see more sizable portfolios, such as Everphone, for instance, with funding of more than 100 million for debt funding. And we also see more interest among banks to really launch that as a product. We see some structure that are set up as an securitization structure and asset securitization structures. Some of them are set up as a specialized lending structure. So there are different ways to go. We also see debt funds investing into these structures. So there seems to be way more appetite now. And I think we see more data in the market. We see more marketplaces where new products are marketed. We have recently advised a company that is producing industrial robots, for instance, for the repackaging industry, for logistic companies, and even those kind of products that sound very tailor-made and sophisticated seem to have a secondary market where you can extract data from, and where you can find sufficient, reliable marketplaces that you can sell off these products.
Right. And just to keep to this might be a bit left field in terms of question, but do you perhaps see in the future where a seed round company could leverage asset-based financing, or do you think that will always be too early?
We have seen these cases, yes, indeed.
All right.
We have worked with companies that have just passed their seed round and have already had access to asset-based lending. It really depends on the company. It depends on the specific assets.
Okay, great.
And I would assume they would have to have also investor support, because setting up such a structure would also require talent in-house that comes from a banking background, that is knowledgeable, that is able to, on the one hand, calculate, on the other hand, to legally understand such structures. And this would mean a cost invest on the side of investors.
Right. And sticking with you, Veronica, from a strategic standpoint, how do you anticipate asset-based financing will change in the next, let's say, 5 to 10 years?
I'd hope it will be more and more available to companies. I believe that from a technology standpoint, maybe tokenization and blockchain would enable us to offer a better security regime than we have today. Securities are complex, especially once a company serves clients not only in their home country, but also in other European countries or even overseas, because security law is different there, and this makes it very costly to check. So I hope that technology and tokenization can be one way out of applying national security law.
Right. I'm working with a company, I won't name them, but they're creating a way of exactly what you said, tokenization for assets based on if they go insolvent, people can buy it off the market quite quickly and pay back their creditors. I'm not an expert in this, but it did sound very interesting. And some of the companies they were
Super
working
cool.
with. Yeah, very cool. But yeah, based out of Switzerland, very cool company. But yeah, so coming to you, Dietmar, what are the most common pitfalls in asset-based financing agreements, and how can they be avoided?
I think just to add to the previous question, I think this basic concept of having an asset co SPV owning these assets already takes out a lot of complexity from a security perspective. So the local security, if you look at assets that are located outside, for instance, of Germany and other jurisdictions, is usually just an add-on to the structure. But usually this security would never get enforced in case of an insolvency. We would just rely on the asset co to be the owner of the assets and being able to repossess it. So sometimes this helps when getting security seems impossible, or it's too cumbersome or not cost efficient. There are certain jurisdictions, for instance, in the Nordic countries where you cannot grant a security interest over movable assets without also transferring possession to the asset, which wouldn't make sense in the case of Everphone, for instance. If they hand out the assets to the debt investor, they cannot rent it any longer to their customers. So in those cases, this basic structure of having an asset co owning the assets already solves a lot of these issues, which would otherwise be impossible to solve with a security interest. Coming to your question about the pitfalls, I think one of the main pitfalls is really to finding the right funding strategy in the beginning of a company's life. What we have often seen in the past is that startup companies often think that venture capital is the way to go, and venture debt funding is the way to get venture debt funding into that business model, and without thinking about whether or not this venture debt would then later on allow them to scale the business. Yeah, so a venture debt provider would usually take security interest over all the assets of the company and would also encumber the business with a lot of negative covenants so that they would not be allowed to take out other financing without the venture debts providers permission. And so if you reach the relevant debt size of this venture debt, you want to grow further, you need to get consent to repay the venture debt. So if a company really has the scalability in mind, they should either start taking up that asset-based lending from the outset, or at least consider when they get a venture debt funding that they have some sort of carve-out provisions in these agreements that would allow them to later on switch to asset-based lending, which is usually the better way of funding if you really want to grow big.
Right. And I don't know if this question is relevant to you, Veronica, but if there's ever been a time, can you discuss a time when asset-based financing did not go as planned?
All the time.
Okay.
So I believe there's pretty much all the time something happening in a startup environment that has not been foreseen. For example, Everphone's third facility was prepared in a way that our customers would do 12 or 24-month contracts, and the facility was signed, and a very large German DAX client called and said they wanted to do 36-month minimum duration.
Right.
So what did we do then? For the first month financing those contracts as if they were 24 months with a huge loss of cash and equity, and then renegotiate with a bank to please allow us to also finance 36-month contracts. Same is happening when a new product is onboarded, when a new amortization profile is onboarded. We're usually having stable rental amounts through the time, but now one of our large Big Four clients is asking whether they have whether they would be allowed to have degressive rentals. How to fit degressive rentals in a security structure? Well, you basically ask the bank, explain them the rationale behind this ask, and then find a solution with them. We're very happy to have banking partners that are flexible, that are quick to respond, and that are willing to consider whatever makes sense business-wise to also appreciate refinancing-wise. But in a business model that's rapidly changing, as is a startups or a scale-ups, there's always something not going according to plan.
Yeah, and I think one of my questions was, you answered it a bit, but how flexible have you found banks in general?
If you select the right banks, and if they're convinced that your business is a great one, they will be flexible.
So question is, how do you select the right bank?
Well, basically, you ask them those questions. I remember in my first refinancing structure, I was talking to that banking partner on the 23rd of December, and I told him, hey, I'm having a balance sheet problem. I need you to refinance more cars between Christmas and New Year's Eve. And he did it, just because they're a smallish bank and they're super flexible. And he was willing to open up his laptop computer and help me out between Christmas and New Year's Eve. That's the kind of flexibility we need. In this structure, we had to do our first drawdown between Christmas and New Year as well. And we had to do it on a Friday, which is a non-banking day for our mezzanine partner, Phoenix. So they just enabled it because they believe in Everphone. They asked their employees to do an extra shift on Friday and pay out the funds. I believe in a good collaboration. That's something banks are willing to do. If they stop trusting you, or if you don't maintain a good relationship, then they won't be as lenient and as accommodating for special requests.
That sounds like a very healthy relationship. And to you, Dietmar, the same question. In general, Because I'm guessing you deal with not just Everphone, probably with other companies as well. How have you found the flexibility of banks in general?
Well, I can only reiterate what Veronica has said, and obviously we see a lot of players in the market. We also gain certain experience from the past when we have seen banks and funds acting in these kind of scenarios, reacting to those special requests, asking for this special flexibility to, well, amend on short-term notice certain requirements in their facility. And we are happy to share this experience with new clients that we take on board and advise on which bank or fund might be the best choice for this particular product. And obviously, over time, when banks get more comfortable with the company and the product, obviously the amount of flexibility also increases over time. So we usually say the first financing that a startup takes up is probably not yet the time when you get the ultimate best terms for it in terms of funding costs and in terms of flexibility. Obviously, the banks at the very beginning try to give you certain restrictions just to control the risk better. But the more confidence they get into the business model, the more data they see, the more track record they see, they will open up to discussions and allow you more flexibility. And then you can start renegotiating the terms of your facility.
Great. Look, we have time for one more question from both of you. So maybe first, Veronica, what advice would you give to startups considering asset-based financing for the first time?
Consider it carefully, but if you are convinced this is the best option, really invest into people, invest into tech, invest into internal processes, and invest into good advisors and lawyers to set it up. It will take some time, but it's totally worth it.
Great. And for you, Dietmar, from a legal standpoint, what are the first steps startups should take when exploring asset-based financing?
We are always happy to bounce ideas at a very early stage. So we get introduced to a lot of startup companies, and we are happy to take a look at their pitch deck, for instance, and give them some preliminary advice how to best present the business to a potential bank. We also make introductions to potential lenders, and we try to already improve the business model wherever it is possible to make it more bankable and admissible for bank funding.
Okay, great. Well, look, for anyone watching, we'll put some details in the description below to get in touch with either Dietmar or Veronica. I'm sure they'll be more than happy to help if they can. But I'd just like to take the time to thank the both of you for joining us today. It's been an absolute pleasure. So yeah, thank you very much.
Thank you for having us.
Thank you, Veronica and Hugo. It was a pleasure.